It sees progress on GAIL's tariff hike proposal that might come in next few months. And last is commissioning of Reliance Solar Module Facility. On affecting all these things, it believes city gas companies like IGL and MGL offering compelling risk reward, saying the timeline of next 6 to 12 months. And in addition to HPCL and GAIL, Citi has opened positive catalyst watch for IOC today as well.
Okay. I was just actually looking at these stocks, IGL and MGL, in the pre-open. Right now, they're quiet. Sudarshan, thank you so much for that. I thought they're really quiet. The thing is, they're so badly beaten down that if there are any believers out there who want to go with the City view and feel that some of this tax change can benefit, let's see if they come in today. Right now, those stocks are flat.
All right. Well, I think just a couple of seconds to go for the market open. 5 seconds. 20 points higher, so it's a slow start. And I think that's reasonable because 10 o'clock you have the RBI decision. So maybe just treading water till then, and then you see the real move come through. 24,699, 24,700. Remember, there's been a sharp run-up yesterday and over the last couple of days. I mean, actually, all the way from the lows of last week, the markets picked up quite a bit of pace. So the start is flat. Stocks, I mean, idiosyncratically, without a broader overlay, can move, and I think that should be the focus, at least between now and 10. And of course, after that, maybe the market itself, the indices itself pick a direction. What else do we have as far as the indices are concerned? Midcap index is flat. Bank Nifty, maybe just a quick look. That is closest to being back at its previous all-time high, 53,600. 54,440, 450 is the last high. So that, again, is absolutely flat. Nothing on it. And we'll put out some sectors, etc. The heat map maybe gives you a quick snapshot view of how many stocks are up and down as far as the Nifty is concerned. And then we'll look at more stuff. But I think let's dive straight into stocks this morning. Surabhi.
Okay, so getting to it, right now the Nifty is down about 7 odd points. By the way, we should check on Segal. Not sure if I don't think there was a block. The stock's down 9%. There was an arbitration, but they have to, I think, an arbitration on an existing outstanding dispute. We'll go back to that story that Vinny was pointing out. Watch out for that one. Name more details on it in just a bit. But anyway, on the Nifty, Trent, Bajaj Auto, ICICI Bank. These are the early movers on the way up. There's ITC also, which is seeing some green, SBI Live, Sun Pharma, Mahindra and Mahindra. And then it's getting really quiet. No major winners. But Trent is the one defining stock, which is moving up in a very clear fashion. 2.5% up now on Trent. And Bajaj Auto is doing well as well. TCS, L&T, HDFC Bank, Infosys. These are some of the weaker names. Again, down by just about 0.5%, not too much. Very quiet after that. Reliance, HUL, absolutely sitting on the fence. There's Tata Consumer, absolutely flat. Very quiet on the Nifty. Nigel, let's focus on mid-caps. That's where the action is.
Well, that's right. Borosil Renewables. The stock had a good run yesterday. There seems to be some protection that's come in there for them, and that's why that stock is up 5.5%. Big up move is what we are seeing. Remember, the management has been rallying for some protection measures on solar glass, and that seems to have come about. So that's why that stock is up 5.5%. Yesterday as well, the stock was higher. BSC continues its good run. It's up close to around 3.5%. So good move out there. Arcade Developers, that's one of the newly listed companies. It saw a sharp correction post-listing. Then the stock has gradually started moving up. In fact, yesterday it was up 7-8%. Today it's up close to around 2.5%. One of the top volume movers. Jyoti Structures, another stock that went to around 40 rupees, came down to around 30 rupees. There's a circuit filter expansion that we're seeing out there. So that could be one of the reasons why that stock is flying away in early morning trade. Chemfab Alkalis, we don't talk about the stock very often. Volume's not very, very high. But that stock, in fact, is up close to around 13%. Axis Gates is another stock that's up close to around 8%. So big move is what we're seeing on that one as well. And Suraj Estates, these volumes relatively higher than what we normally see. So just pointing out some of these names. Big up move is what we're seeing. Ramco Systems as well. That's another stock that's moved up. Jai Bharat, that stock is down close to around 9%. So I'm not sure what's gone on there. And for the second day running, there is some mild profit taking that we're seeing on Genus Palm. So keep an eye out on that stock as well. And HEG, yesterday, a lot of block trades out there. The stock ended mildly in the green after being up more than 6% at one point of time. But HEG is the one that's now down close to around 3%. Graphite or graphite electrodes? Well, there was a bit of confusion on that one. So I think now it's seeing some profit taking.
Okay, well, graphite was down about 5 and 5.5 yesterday, and HEG is also now following with some cuts. 13 points. It's absolutely unchanged, actually. Not very much at all on the indices. BSE is the biggest volume-led gainer, like yesterday. BSE is at number pole position, another 2%. Borosil Renewables is up at number 2. Second day running. I think it's moved up from levels of 440 to 540 in 3 sessions. Borosil Renewables. We, by the way, spoke with Mr. Keruka recently. We have Sagility, which is up 3.5%. It's at number 3 position in terms of volumes, big gains. Rights is up about 3.5%, 4%. Zentech is up 4%. There is NetWeb, which is up 3%. Some of these are newer names you don't see very often at 9:15 straight at market open. PG Electroplast has been making highs, 3% here again. Rain Industries is up about 3.5%, 4%. EMS Limited will come up about 3.5%, 4%. Westlife, that's the McDonald's franchise, 3% higher on that one as well. I mean, it's an easy 2:1 advances to decline ratio. I was talking about Angel One, before market open, and you had those flashes come through. We'll invite the management on as well. Angel One is the biggest volume-led loser. It had a bit of a pop. I think we got the monthly numbers which show a bit of a decline in terms of transactions, etc. And stocks at about 3,115 with some cuts coming through. Well, let's... sorry,
Prashant, just putting this out for clarity. The rate on Segal India will change that rate. Don't go by this because it's some technical issue. The stock is not down 9%. It's actually up 2 to 3% because the news is positive. The arbitration award is 54 crores in the company's favor.
Yes.
So there's nothing wrong. Just ignore the rate. We'll fix it and come back. Yeah.
All right. Well, so that's some clarification coming through as well. But let's move forward and let's get into an exclusive conversation now. Jonathan Garner is Chief Asia and Emerging Markets Equity Strategist at Morgan Stanley, and he's joining us on the channel now. Jonathan, good morning. It's a pleasure having you here on the program as always. Prashant this side. I want to start with growth, which seems to have hit a bit of a road bump recently, Jonathan. Nominal growth has dropped to 8%. That's what corporate profits track. What's the sense, Jonathan, and how should we read this? You've been a big bull on India, best performing market, best growth prospects, etc. But it's a bit disappointing. I mean, we're in the 5% handle now, real growth.
Yes, you're right, and we've been watching that closely. I should say we remain constructive India. We are overweight. We believe we're in a secular bull market, but we have had this cyclical slowdown. And I think the debate with investors is, when does the kind of growth pick up again? And the view that we are getting from our economics team and from Ridham Desai, our strategist, is there were some quite unique features behind the slowdown. We obviously had the election. We then had a lot of rain in August. We had some changes in the lunar calendar. And what we're now actually seeing is the early signs of a pickup. And we do think that government fiscal spending will come to the fore again. And we are optimistic that in the first half of the calendar year next year, so that is the second half of the financial year, as it were, in India, as we go through to the end of March and then the end of June, we will see a pickup. And so we are above consensus on earnings growth. Those earnings estimates have come down, but we think earnings growth moves back up again. And we have a 93,000 target for Sensex for December of 2025, which means it's got more upside than pretty well anywhere else other than Japan in our coverage.
Jonathan, what does it mean for... two questions, actually. Does growth need a bit of help? You said fiscal on the government side. RBI today, by the way, and we'll hear from them as well. There'll be an acknowledgement. What they do about it, we'll have to wait and watch. Do you think we need a bit of a push now, both from the monetary and fiscal side? And is that certainly going to be possible with what's happening globally, in the US especially?
Oh, absolutely, because the US rates environment is softening. Rates are coming down. I don't think the monetary side is as important as the fiscal spending side, which will come to the fore. But on the underlying consumer and industrial investment cycle is also, we think, intact and very much in contrast with what's going on in China, which is in structural deflation. So we do think this is a sort of 2-quarter cyclical slowdown. It's not likely anything worse than that.
Okay. Jonathan, hi. Great to have you on the program. And it's good to hear that you're still keeping the faith, so you're not too perturbed about this last GDP print. But having said that, a lot of people here in India are arguing for, more stimulus, monetary stimulus for sure. CRR cuts, repo rate cuts. How important is that in your projections for the Indian equity market? What are you penciling in from the monetary side as of now?
Well, as I said in answer to the previous question, relatively little, maybe 50 basis points off rates. But these growth numbers that India is still producing are still just about the best in the world of any major economies. I mean, if you look at the US, growth is slowing. If you look at some of the markets that we're negative on, for example, Korea, that's in the news right now, we're predicting like a one handle on GDP growth in Korea next year. And the markets are more exposed to sectors like autos and semiconductors globally, where there's a cyclical slowdown underway. They are likely more pressured, and in many cases actually are starting to underperform. So I really wouldn't be too alarmed on the situation in India. It looks good to us.
That's, again, like I'm saying, from our perspective, that's really reassuring to hear. But on the US, if you could just expand on that, because the narrative of the last two to 3 weeks, actually since the 5th of November, has been this whole American exceptionalism, right? Just buy America,
yes.
Everything America. So are you saying that that's gotten a little excessive?
Well, our key overweights globally are the US itself, Japan, and India. Those three effectively. And we are most cautious on Europe, on global EM, and within EM on Korea and China. They're our biggest underweights. So India sits there as one of our top 3 preferred markets globally. It's true that the US is getting a lot of attention. And one of the themes that we talk about in the emerging space is that emerging markets as a whole doesn't really make sense as an asset class anymore. We've basically said for some time that you need to pick your individual spots. And India is one of the places that we like. There are others that we like that are going through idiosyncratic positive stories, South Africa, for example, and parts of Southeast Asia. But I think that it's not so much the case as will money move out of the US to buy EM. It's more like, can you identify really quite a unique opportunity, which we think India represents, to participate in a structural bull market? Do remember that earnings in India have been growing around about 15% per annum compound dollar over the last 3 or 4 years. Slow down right now, then hopefully that resumes. And that's way, way better than emerging markets in aggregate that's struggling to deliver any earnings growth, or China, where earnings growth are actually falling.
Hi, Jonathan. Good morning and good to see you in. This is Nigel on this side. Jonathan, the FI selling picked up big time in the last couple of months. And we are thanking our stars that, in fact, that slowed down at least in the last few days. Do you think bulk of that FI selling is done? Because the FI holding in the Indian markets has come down to the lowest we've seen in the last 10 years or so. Your take?
I think you're referring to the percentage of the market owned by FIIs yes. rather than domestic investors. And certainly one of the reasons we're bullish India is the domestic investor bid. The young demographic getting formal sector jobs, interested in their country's future, investing in stocks. The FIIs you're referring to, that tends to be related to the legacy situation in relation to active emerging equity funds, where you're getting these redemptions. And to some extent, a short-term tactical bounce in China around about the middle of September, around about the time that this growth slowdown in India also became visible. However, that tactical bounce in China, in our view, is fading and likely to fade quite badly as the adverse growth drivers reassert themselves. Meanwhile, with the IPO, the secondary issuance, and the underlying outperformance we think of India, its weight in EM is rising, but it's also, for the first time ever, coming on the radar screens of truly global investors. If you look at the ACWI EMI index or broad equity indices, it's up to about 2%. And at that level, truly global investors start to make trips to India. They start to look at the first 1 or 2 stocks that they can add to a global portfolio. And that's where the future lies. To some extent, it's what happened a decade ago for China when the major China internet names found their way into global portfolios. That's now reversing, but that story lies ahead for India.
Jonathan, you made the growth comparison here vis-a-vis some of the other emerging markets. The sobering thought, though, is that we're a $3 trillion economy, and growth is now coming in the 5% handle. China is almost 19 trillion, and last year growth was 5%. So actually, from an India perspective, we've got no business slowing down, right? Like this, to drop to, we must do all we can to sustain high rates of growth for a long period of time? Because I guess that's what a lot of this thesis is dependent on. Higher consumption and a bigger consuming class.
Yeah, so those numbers you just quoted are, I guess you're thinking about real GDP growth numbers on official estimates, okay? If you actually look at what's really going on in terms of nominal growth, even on official estimates, Indian nominal GDP growth is 2.5 times that of China, still is, because you've got the real growth plus the inflation. And if you look at what's actually going on the ground, what multinationals are telling you about their businesses and what corporate earnings is actually compounding at, as I said, Indian corporate earnings are compounding easily in double digits at the moment in dollars, and Chinese corporate earnings are struggling to grow at all. So it is not the case, frankly speaking, that India's economy is growing at the same pace of China's. That's not what's happening in reality at all.
There is the inflation component, no point taken. Jonathan, just to take that point forward with regards to China, as we head into 25, I mean, of course, 20th is inauguration in the US. But already, I mean, they've started moving on various things and giving out indications, the Trump administration, what they want to do. Do you think, the policies towards China will be as adversarial, which benefits this China +1, and India has been a beneficiary of that over the last couple of years? Or maybe this is a bit of a reset with Musk at Mr. Trump's side. Maybe, it need not be. It's a reset, and maybe in a slightly incrementally positive way. What's your sense? That's not consensus, though. Go on.
Yeah, I think this is administration that is likely to materially increase tariffs and non-tariff barriers on China. We're anticipating over 18 months the effective tariff on China from the US goes from about 12% to 36%. And that will add to China's growth difficulties and probably also pressure the currency lower as China responds to that. And indeed, one of the long-run themes when we go back to this dollar earnings growth that I've been emphasizing is the Indian rupee is now more stable than the Chinese renminbi. There's a role reversal there. And India is very unlikely to suffer the same kind of trade pressure for all sorts of reasons as China will from the incoming administration. So that is an important headwind, and it's part of our thinking. And it's why our China economist actually expects China growth to weaken even further next year. Whereas I just said for India, we expect a cyclical pickup to resume.
Which also brings me to the next question in terms of what to play in the India market, Jonathan, and what you like. A lot of people will want to believe that China's loss will probably be India's gain, because we saw that play out at least in COVID, right? COVID, when there was supply chain disruption, a lot of the Indian API manufacturers, those who are making these bulk drugs, chemicals, those companies started doing really well here in India. But that was a different time. Now we're talking tariff wars. So again, do you expect any China +1 benefits at all for India? And beyond this, what are the other top themes that you'll continue to like here?
So working with Ridham and the team, we are overweight financials. That's actually a global trade at Morgan Stanley. We like financials pretty well everywhere other than in China. We also are overweight consumer discretionary in India and industrials. And we like the IT services names. They're very engaged and working hard on the AI rollout globally. And we're deep now into the shift from enablers to adoption. So adoption basically is AI being adopted by major software services firms, major global financial services firms. So the India players in that sector are very engaged in all of that. And we are underweight the defensives and certain other areas like energy and healthcare. And we're pretty happy with that approach. I think you were just mentioning before I came on your show that the banks index in India is basically almost back at the high already. And we're seeing that bank's outperformance in many markets.
Okay, all right. Thanks a lot, Jonathan, for joining in and giving us your quick take on how you see the global markets shape up, particularly India. You're sounding rather optimistic on prospects, 93,000 on the Sensex. So that's a good upside from these levels.
Thank you.
Well, let's focus on the paint industry now. Competitive activity in the sector has increased. Birla Opus has been expanding capacity as well. According to analysts, they say that competitive products from Birlas have found some resonance among dealers. How do the peers see
Oh,
this?
Nigel,
I think
just a
we've
second.
got
The
the RBI
man of the day.
Governor walking in. That's the RBI headquarters. And a lot of focus on this particular RBI policy, both for what the RBI will do. They will acknowledge the slowdown which we've seen, but what will they do about it? Forex swaps, OMO, CRR cut, and he's gone in. And of course, the other part, of course, is the extension. Whether the governor himself will get an extension, because we are due to hear about that. And we thought we'd probably hear over the last couple of days. It's not happened yet. And I think there will be questions on that as well. Just about 25 minutes to go for the policy.
For a man who has so much on his mind and so much riding on his shoulders, the whole Indian economy, he always manages a wonderful, graceful, benign smile, does he not? Always, at ease.
He was the man. He was the man in Delhi during COVID. And if you remember those briefings, right? I mean, he was always sort of calm, composed through, and it was always a pleasure.
Well, and done a very, very good job. Sometimes you compare other central bankers across the globe and you feel proud the way the RBI has dealt with the situation. Well, we'll get to that in just a bit. But as I said earlier, let's get to Berger Paints. We have Abhijit Roy, the Managing Director and CEO at the company, who joins us on the show. Hi, Mr. Roy. Good morning, and thanks a lot for joining in. Well, how has demand been? I think earlier you were guiding for around a 7 to 8% volume growth for Q3. Is that on course? Is that a little bit better?
First of all, congratulations to you and the channel for reaching this 25-year mark. It's been a fantastic journey for CNBC. Q3, as I said, we had thought of that it will grow at about 7-8% by volume. As of now, it is slightly lower than that. Around 4 to 5% is where we are as of October and November. We are hoping that December will be better.
Got it. Okay. All right. So a little lower than what you were estimating earlier. Well, Mr. Roy, we thank you for your good wishes for the channel. And also, you've always colored up the screen for us. So we appreciate that. But let's talk about business. The competitor, Birla Opus, that's been making inroads. It's adding capacity. It's, got a fair bit of traction with the dealer community as well. And now they are, number 2 in terms of capacity. Do you think that they are a big challenger and, that number 2 position is under risk?
Well, first of all, that data is incorrect that they are number 2 in capacity. They are still actually around half our size in terms of 3-shift capacity that we have versus theirs. In fact, in the annual report of last year, if you see, we have 1.5 million tons of capacity per annum. Vis-a-vis that, they have declared about 83,000 or 84,000 metric ton capacity so far. So that itself is incorrect. But even if you take that aside, the fact is that capacity is not very important in the paint industry. We operate at around 60-65% of our capacity even today. And therefore there is enough capacity to produce. What is important is production and sales, and that is something which I think we are way ahead of them as of now, right? The second part is I think if you add too much of capacity at the initial stage, the return on capital will get hampered very badly, and we add capacity as and when the sales improve. So I think that is a better way of looking at things rather than looking at the capacity part. However, there is competition and that is increasing, and we are on our toes. It helps us to become more efficient, so we are okay with that.
So to take that point further forward, I mean, they might be at whatever capacity. Eventually, there's a scale-up happening, right? And there are large players in the market now, which brings me to the earlier projections that we got from you. You're saying November, it's been around 4-5% volumes. For the entire second half and for the full year, you told us that volume growth of 8% is perhaps possible in the second half. And there was a lot of talk of more value growth as well, price hikes. Now, is that still on the table? Can you tell us how prices have moved? And for the overall second half, what will both the volume and the value growth, what will the numbers look like?
Yeah, so, we stand by that. I think, we are expecting that the fourth quarter will be better than the third quarter as well. Third quarter is slightly better than the second quarter. So from that perspective, it is more or less in the same trajectory that we had predicted. We expect that, 8 to 9% volume growth should come in the overall second half. And the value growth, because we had a price dip last year, that will go away in the fourth quarter completely. So the value growth will also look up in the second half. Comparative to first half, it will be the gap between volume and value will be lesser.
And what is the price hike? I mean, you're anticipating, just so that we have a sense, as you're saying, the base was lower last year. Just to understand the numbers, roughly what are we expecting on pricing?
So we took a price increase of 2.5% in the second quarter, and the price drop that had happened last year was about 5%. So this entire impact will come in the fourth quarter.
Mr. Roy, good morning. Prashant here. The other bit of news flow, right? The AkzoNobel sale. Is there anything you'd like to tell us regarding that?
So far, no material discussion has happened, so I can't really say anything, Yes, there are talks there going on, and in the press, they have said that they are looking and reviewing this portfolio. As and when things develop, if there is anything constructive, we will let you know, for sure.
Mr. Roy, as you said in the press, they've said they're looking. So obviously, privately, it would be at a much more advanced stage. So,
well, so far it hasn't moved to any significant stage or of any material importance. I would say in that way.
But you were in it as well. You're speaking with them.
We look at all. If the valuation makes sense, only then we are in it. Otherwise we will not be in it. So we take a look at all opportunities. If it makes sense, we will definitely look at it seriously. Otherwise, we will walk off.
So is there a process which is being followed, like some due diligence or?
No, nothing. No due diligence has happened so far. We haven't proceeded to that stage as yet.
But talks also haven't started, you're saying, or have the talks begun?
Talks in the sense that discussion always happens, right? As to whether we are interested, not interested, NDA has to be signed or not signed. All those things sometimes can take some time, legalese and other stuff. But as of now, there is nothing concrete or material which is of importance.
Mr. Roy, just to press you a little bit on that competitive intensity, I get that point. Capacity is not the matrix. Sales is the matrix. Now, the thing is that the Birla Group, they are selling white cement, they are selling putty. And now, in fact, if someone is doing that, they could very well be tempted to continue to use their paint as well. So that question is could they be a serious challenger? I think in terms of sales volumes, you could correct me, but I think you're number 2. So with them having adequate capacity, and as it is they're selling putty, as it is they're selling white cement, do you think that number 2 position could be at risk, or you think no, you're well equipped?
No, so there are two reasons. Of course, they are a challenger, no doubt on that. They have some advantage in the sense that what you mentioned about putty being sold or cement being sold. But that is typically, the cement part of it is basically for new projects, right? And new projects in paint trade is about 15% of the total sale. It is repainting, which is about 85% of the sale. So that has to be built up over a period of time in terms of distribution, in terms of painter connect, in terms of architect, interior decorator connect. Those things take time, and it doesn't happen overnight. And there are issues there. It takes a long, slow process. It is not something which will happen overnight. And that is why, and meanwhile, we also keep expanding. We have our own expansion plans. We have our own growth plans. I don't see, therefore, that happening in a hurry. It will take a long, long time if it ever happens.
Very solid point, sir, and completely take that point. You're saying that, the absolute fresh painting of new houses or new homes, that's only 15% of the trade. The rest is all repainting, and that's where brand recall, sort of association with a brand, the belief and credibility with the brand, that's really paramount. So take that point completely. Just to complete, sir, the point on pricing. You said last year there was a 5% price drop, 2.5% you did in Q2, so you've made up. Now you're expecting further price hikes in Q4. So will it be another 2.5%, which means basically you make up for the price drop? Or can you hike prices even further, given the competitive intensity in the market?
What I was trying to say is that we were at a disadvantage when we dropped the price last year by 5%. So when I am growing by 10% by volume, my value growth is showing only 5% because of the 5% drop which happened in the month of January and November and January of last year. So What is now going to happen is that disadvantage is going to go away. So that 5% disadvantage that we were living with right up to now is going to go away completely. And in that place, there will be a 2.5% added advantage because of the price increase that we have taken in second quarter. So the net impact will be about 2.5% in the fourth quarter or 2.3% in the fourth quarter plus. And in this quarter, it will be more or less flattish, which means we won't have a disadvantage of volume and value gap, which was existing earlier.
All right, Mr. Roy, we'll leave it there. Thank you very much for joining us. It's a pleasure having you with us here on our special day. Thank you indeed. Well, that's Berger with perspective on the cement industry, competition, price increases, and of course, what's happening is with regards to that AkzoNobel asset. I think we're going to take your early leave on Bazaar here because our policy coverage kicks off on the other side. We connect with a host of experts to discuss if the RBI will cut rates today or maintain status quo. Of course, 10 o'clock is when we'll hear from RBI Governor Shaktikanta Das. Stay tuned. That's all coming up on the other side of this break.
Hello and welcome to our special coverage of the monetary policy. Hello and welcome to an all-important monetary policy coverage from CNBC-TV18. Big day for us. We complete 25 years, and it's almost as if divine grace that the Reserve Bank has chosen to date an all-important policy on this day. So we feel it's a double delight for us. Well, I tried my luck. We were with our cameras waiting to welcome the governor into the Reserve Bank. I tried asking him, sir, any goodie bag for us? And of course, he smiled and said, you will know. And of course, we're going to know in 10 minutes or so. We have a battery of guests and my colleague Ritu Singh, who did the CNBC-TV18 poll. So welcome, Ritu, and over to you. The poll says that there isn't a repo rate cut just yet.
Yes, Lata, in fact, 100% of our respondents say no repo rate cuts. So for the 11th consecutive time, a status quo policy. But to acknowledge this slowdown in growth, there could be a dovish commentary from the governor. And instead of a rate cut, there are some chances there's a section of the market that is expecting a cash reserve ratio cut ranging between 25 to 50 basis points. But the chances of that happening, according to our poll, are 50-50. So we'll have to see how that plays out. In terms of when the next repo rate cut could be, largely now the market is aligned with February. That's when we'll start to see the rate cut cycle. In terms of the other parameters, of course, the GDP number is going to get all of the eyeballs. 7.2% is the number. It has to be revised down. To what extent, we'll have to see. Our poll says about 6.4 to 6.7%. Inflation currently at 4.5% for the year might have to be revised upwards. Our poll again says between 4.8 to 4.9%. Some even say 4.6 to 4.7%. Apart from this, a lot of focus will be on the liquidity measures, whether there is a VRR, some sort of OMO purchases. What the governor does to assure the market that liquidity will remain comfortable is also something that everybody will be watching out for. And of course, the big question mark, the Reserve Bank of India governor's tenure, that ends on the 10th of December. We're yet to hear from the government on that front as well.
Can't hear it. Thanks for that comprehensive poll analysis, Ritu. Let's invite our guests. We have Kaushik Das, the chief economist from Deutsche Bank. We have Indranil Pan of Yes Bank, with Devang Shah of Axis AMC, and I think Lakshmi Iyer of Kotak is going to be with us in just a minute. Actually, let me start, because it's a CRR cut cry. Let me start with the market guy first. Devang, what are your bets? CRR cut for sure?
Yeah, we are more in the CRR cut camp. So yes, definitely, as Ritu highlighted and you highlighted, growth has actually come lower and it's rang some alarm bells. But we believe that the need of the hour is actually liquidity, which would be supportive both for credit growth and the economy on the longer term. Hence, our view is that RBI should be looking at liquidity infusing measures today and probably start with rate cuts from Feb. We also believe that this is in sync with their monetary policy stance, which they announced last policy. So I'll go with CRR cut.
All right. Let me get to Kaushik. Kaushik, is there a chance of an accommodative stance?
Lata, that is too early. They changed the stance to neutral. Even, you can cut rates with a neutral stance. So it doesn't stop them from cutting rates as well. Now, the question that you asked, I think, we are going with the base case scenario of a CRR cut. And we gave that call even before the GDP data came out, because liquidity was getting, tight in the system. So if you need to do a rate cut for the transmission to happen effectively, you need liquidity to improve. And therefore, I think after changing the stance to neutral, the good sequencing would be to cut the CRR. CRR is at 4.5. For the longest time, it was at 4% before COVID, so it can come down. And then you cut the rates in February and April. But with RBI, you never know. It can always give you a surprise and cut rates today itself, saying that we are a forward-looking central bank. Inflation is expected to come down. So if you have to cut in February, why wait? And they can deliver a cut in December itself. But that's not our base case view as of now. We think CRR cut is more likely, followed by a repo rate cut in February and April.
Okay, let's get Lakshmi in. Lakshmi, your call. What's in for today? Is a CRR cut almost a given now?
Yeah, hi Lata, good morning. So yes, there is, though the core system liquidity obviously is much lower than what it was in September. But, taking cue from what Kaushik just mentioned, I'm actually reminded of a quote by, which is attributed, of course, to John Maynard Keynes, that if the facts change, I change my mind, what would you do, sir? So if that question were to be posed to the governor, clearly the mellow down in GDP growth definitely points to a case to definitely look at a possibility of a rate cut. Of course, I know it's a non-popular view and obviously not our base case view as well, but it's a very, very outer chance. But clearly, if you signal something to that effect, so today I think more than walk, it is more about the talk. So a combination of CRR plus probably even open market operations, that's something which the markets have been indicating or expecting. I think a combination of either or should keep the market, I would say not euphoria, but should keep the market mood intact, which right now is definitely expecting a significant dovish undertone.
Well, so net, the market is expecting some cues from the RBI Governor that liquidity will be kept comfortable. Whether that is through a CRR cut or not, we'll have to see. Indranil, our experts here unanimous in their expectations of a CRR cut today from the Governor. I know you have a contrarian view, so tell us about that.
We are not expecting a CRR cut, neither are we expecting any rate cut. A rate cut, I think everybody is on the consensus view, though some of my colleagues here sort of tend to be on a knife edge and they can fall on either side. But I think with a 6.21% inflation reading and with Trump policies coming whereby global interest rates and inflation can remain on the firmer side, it's possibly not the right time to do a repo rate cut. Yes, growth has been slowing down, but there are also consensus views coming that some amount of the slowdown is because of certain factors which were not in the control, including the fact that there was a base effect from the previous year. And some of the early indicators that we see for October is pointing to a more stable growth. It's quite not true that we would be or we should have been expecting a 7.5% growth in an atmosphere where the global growth is on the negative footing. And I would be happy to see a more qualitatively good growth at around 6.5% or so, which is where we are sort of tending, and more normalization into the pre-COVID sort of situation. So I'm not, and in terms of the CRR, I think CRR is a more permanent liquidity infusion. And the banking system liquidity, which is, I actually look at more the banking system liquidity rather than the government balances included, which is the core liquidity. And given today's situation, I'm not expecting a CRR cut. Yes, they will be absolutely clear about the fact that they would be nimble-footed in terms of adjusting liquidity as the need may be. I would prefer to see the RBI more on an OMO journey, because there is space there to sort of ramp up the rupee securities, as the foreign securities have also sort of fallen.
Okay, so that's a 3:1 on the possibility of a CRR cut. Kaushik, very briefly, let me pick up from where Indranil left on the growth numbers. That is where a lot of focus again is going to be. 7.2%, most likely will be lowered, but to what extent is the question? Because there's some in the market all the way down to a 6 to 6.3% kind of a range.
So, Ritu, in order to get 6.5%, you need to have 6.9 or 7% average for the second half of the year. We have a 6.5% average for the full year. And, that brings in, factors in 6.9% growth. The reason being government spending will pick up in the next few months. And, you probably could see a bounce back even in October, December. Manufacturing activity is expected to be better than July, September. So all built together, probably you will get, close to 6.9, which can lead to 6.5% growth. But the risks are obviously to the downside, because the second half of the fiscal year will have to contend with a very high base year of the previous year. We had high growth last year on, absolute terms. So it could be a challenge to get close to 6.9. RBI had a growth forecast of 7.4% for second half of the fiscal year. If they keep that constant with the first half growth that you've got, RBI could come down to 6.7, 6.8. But ideally, they should be at 6.5 or lower to do the proper mark-to-market, for this year. And more importantly, next year, RBI has a growth forecast of about 7%. We are at 6.5%. So the story that we think is building up is that India is probably going to be at 6.5% average growth for some time, which is below potential. And therefore, you need some monetary policy support to make sure that growth doesn't fall below 6.5 for the next few quarters or years, given that the global backdrop is going to become challenging. The tariff wars and other things from the US administration could slow down global growth. To that extent, if India is continuing to do fiscal consolidation, and we think India will reduce the fiscal deficit again next year to 4.5% or lower, then you need some monetary policy support, and some repo rate cut of 50 to 75 basis points is needed in this cycle.
Yeah, Kaushik, we are running out of time. Kaushik, we are running out of time. Devang, just give me the bond yield range you are expecting over the next 1 month. Just a quick one.
660 to 670.
Okay, and Indranil, any guess on the rupee?
I think by March end we should be at 85 to 85.25.
85.25. Okay, there has been a bit of a quiet on the dollar, and some bit of risk is coming back. Maybe it's just excessive short positions on other currencies that are getting covered, but the dollar has shaved off a bit. There is still the non-farm payroll, and there is always the possibility of any Trump statement coming over the weekend. So the markets will have to watch, the currency markets in particular, as to how they react. Over to you, Ritu. I think it's the last few seconds before the governor takes over.
That's right. We're standing by to hear from the governor at 10 a.m. So any moment now, just to recount what our guests have been saying in the meantime, the large majority is leaning towards not a repo rate cut, but a cash reserve ratio cut. It could range between 25 to 50 basis points. So 50 basis points will release about 1.15 trillion rupees of liquidity into the system. So that will bring some relief to the banking sector. Apart from that, the GDP number, again, will be the focus area. RBI will have to climb it down from the 7.2% currently, even if we get a 7.4% in the second half. So the expectation is anywhere between 6.5 plus minus 20 basis points. We'll have to see where that goes. And, on the inflation front, 4.5% is the current projection. How much that is raised, we'll have to see. Again, our, poll says anywhere between, 20 to 50 basis point, sort of revision. That could likely come. 50% expecting a 4.8 to 4.9. Here are the governor.
Every 2 months, I have been presenting the monetary policy statement on behalf of the Monetary Policy Committee and the Reserve Bank of India before you. In fact, a detailed, elaborate statement presenting before all of you is a practice which we started during the period of the COVID, when there were lockdowns and restrictions. We considered that this was the most appropriate way of communicating with the people and with every stakeholder in the economy. Monetary policy is important because it affects the life of people. It affects each and every segment of the economy, howsoever small or big. It affects the vegetable vendors. It affects the big corporates. It affects the middle class. I think it also affects the farmers, the industry, the business. So it has wide-ranging impact on the economy, and that is why I'm sure that is the reason why most of you are listening to the governor's statement. Our effort is to follow the flexible inflation targeting framework as provided in the Reserve Bank of India Act. The Act provides that the Reserve Bank, that is the Monetary Policy Committee, is expected to maintain price stability. In fact, it is a mandate. The mandate given to the Reserve Bank of India is to maintain price stability while supporting or keeping in mind the objective of growth. Price stability is important for the people because it affects their purchasing power. It is important for stability of businesses. It is important for exporters and importers. It is important for every segment of the economy. So price stability is important. At the same time, growth is also very important. As an economy, India has been growing in the last 3 years at more than 8%. Growth, that is the GDP growth, the growth of the gross domestic product, is also very important. And as provided in the law, it is always our effort at the Reserve Bank of India, it is also the effort of the Monetary Policy Committee to follow the provision of the law as embedded, as provided for in the Reserve Bank of India in letter and spirit. So with these opening remarks, I present before you the monetary policy statement of today. And this is how it goes. As we stand at the threshold of 2025, let me reflect upon the eventful journey of 2024. In line with the trend in the last few years, central banks were once again put to the ultimate test to stabilize their economies against continuous, colossal, and complex shocks. Central banks are constantly adapting to the new global economic and financial landscape created by geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and continuing uncertainties, all of which are testing the resilience of the global economy. The last mile of disinflation is turning out to be prolonged and arduous, both for the advanced economies as well as the emerging market economies, that is the EMEs. Maintaining macroeconomic and financial stability and building buffers continue to be the lodestar, especially for the emerging market economies. In India, notwithstanding the recent aberration in growth and inflation trajectories, the economy continues its journey on a sustained and balanced path towards progress. Amidst the reshaping of the global economy, India is well positioned to benefit from the emerging trends as it forges ahead on a transformative journey. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, which met on 4th, 5th, and today 6th December. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook, the Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided unanimously to continue with the neutral stance and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend, and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output, and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets. Going forward, the outlook is clouded by rising tendencies of protectionism. I'm talking about the global economy. Going forward, the outlook is clouded by rising tendencies of protectionism, which have the potential to undermine global growth and also push inflation higher. Let me now turn to the domestic growth situation. Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated. This decline in growth was caused mainly by a substantial deceleration in the industrial growth from 7.4% in the first quarter to 2.1% in the second quarter due to subdued performance of manufacturing companies, contraction in mining activity, and lower electricity demand. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. The end of the monsoon season and the expected pickup in government capital expenditure may also provide some impetus to cement as well as iron and steel sectors. Mining and electricity are also expected to normalize post the monsoon-related disruptions. I specifically commented on these sectors, that is on manufacturing, on electricity, and also on mining and iron and steel, as well as on cement, because these were the sectors, particularly in manufacturing, mining, and electricity demand, which were the principal factors which pulled down the GDP number in second quarter. So that's why I have focused how these three sectors are expected to behave in the current quarter as well as in the next quarter. The Purchasing Managers Index, that is PMI for manufacturing at 56.5 for November, remained elevated. The supply chain pressures eased in October, November, and fell below the historical average. The services sector continues to grow at a strong pace. PMI services remained steady at 58.4 in November, indicating continued expansion. On the demand side, rural demand is trending upwards, while urban demand shows some moderation on a high base. Government consumption is improving. Investment activity is also expected to improve. On the external front, merchandise exports expanded by 17.2% in October, while services exports continued to post upbeat growth at 22.3% in October. Taking all these factors into consideration, real GDP growth for 2024-25, that is the current year, is now projected at 6.6%, with Q3 at 6.8% and Q4 at 7.2%. Real GDP growth for the first quarter of 25-26 is projected at 6.9% and the second quarter of 25-26 at 7.3%. The risks are evenly balanced. I would now like to focus on inflation. Inflation increased sharply in September and October 2024, led by an unanticipated increase in food prices. Core inflation, though at subdued levels, also registered a pickup in October. Fuel group remained in deflation for the 14th consecutive month in October. In the near term, despite some softening, lingering food price pressures are likely to keep headline inflation elevated in the third quarter, that is, in the quarter October to December. Going ahead, a good Rabi season would be critical to the softening of food inflation pressures. Early indications point to adequate soil moisture content and reservoir levels, conducive for Rabi sowing. The estimates of record Kharif production should bring relief to elevated prices of rice and tur dal in particular. Vegetable prices are also expected to see a seasonal winter correction. On the upside, the evolving trajectory of domestic edible oil prices following the hike in import duties and rise in their global prices need to be monitored closely. Manufacturing and services firms surveyed by the Reserve Bank point to firming up of input costs and selling prices in the fourth quarter of the current financial year, that is in the quarter January to March. Taking all these factors into consideration, CPI inflation for the current financial year, that is 24-25, is projected at 4.8%, with Q3 at 5.7%, Q4 at 4.5%. Going into the next financial year, CPI inflation for the first quarter of 25-26 is projected at 4.6% and Q2 at 4%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have described the growth conditions. I have described the inflation conditions. Now, what do all these factors mean for monetary policy? And that is what I would like to now highlight. The near-term inflation and growth outcomes in India have turned somewhat adverse since the last monetary policy in October. The medium-term prognosis on inflation suggests further alignment with the target, while growth is expected to pick up its momentum. Persistent high inflation reduces the purchasing power of consumers and adversely affects both consumption and investment demand. The overall implication of these factors for growth is negative. Therefore, price stability is essential for sustained growth. On the other hand, a growth slowdown, if it lingers beyond a point, may need policy support. The Reserve Bank's anti-inflationary monetary policy stance has been a crucial factor in bringing about a significant disinflation. Going forward, as food price shocks wane. Headline inflation is expected to ease and realign with the target as per our projections, which I just read out. At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation. The gains achieved so far in the broad direction of disinflation, notwithstanding the recent upticks, need to be preserved. At the same time, the growth trajectory and the evolving outlook also need to be monitored very closely. At this critical juncture, prudence and practicality demand that we remain careful and sensitive to the dynamically evolving situation with all its complexities and ramifications. A status quo in monetary policy in this meeting of the MPC has thus become appropriate and essential. I would now like to turn to liquidity and financial market conditions. System liquidity as represented by the net position under the LAF, that is net LAF, that is net liquidity adjustment facility, it continued to remain in surplus during October and November on account of higher government spending, despite a significant increase in currency in circulation during the festive season and capital flows. Of course, towards the end of November, for a few days, the liquidity became tight, but overall, I think there was adequate liquidity both in October and November, and it remained in surplus. Given these conditions, the Reserve Bank mainly conducted variable rate reverse repo operations, that is VRRR operations, to absorb surplus liquidity. To alleviate temporary liquidity tightness because of large GST outflows, however, fine-tuning variable rate repo operations, that is VRR operations, were conducted intermittently during October and November. The two-way liquidity operations of the Reserve Bank ensured close alignment of the interbank overnight rate with the policy repo rate. Transmission to the credit market has been satisfactory. As you would have noticed, as in the previous monetary policy statements, a lot of data is given in the footnotes. So those of you who are interested may have a look at the footnotes, because the data in the footnotes justify and back up whatever I am saying as a part of my statement. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the coming months due to tax outflows, increase in currency in circulation, and volatility in capital flows. To ease the potential liquidity stress, it has now been decided to reduce the cash reserve ratio, that is, to reduce the CRR of all banks to 4% of net demand and time liabilities, that is NDTL. And this will be done in two equal tranches of 25 basis points each, with effect from the fortnight beginning December 14th and December 28th. This will restore the CRR to 4% of NDTL, which was in fact the prevailing rate before commencement of the policy tightening cycle in April 2022. The reduction in CRR is consistent with the neutral policy stance and would increase primary liquidity of about rupees 1.16 lakh crore, that is 1,16,000 crore, to the banking system. Going forward, the Reserve Bank will continue to be nimble and proactive in its liquidity management operations to ensure that money market interest rates evolve in an orderly manner and the productive requirements of the economy are met. During 2024-25, that is from the period April to November, the Indian rupee depreciated by 1.3%, largely due to pressure from strengthening US dollar and selling pressure by foreign portfolio investors, especially in October and November. Nevertheless, both the depreciation of the Indian rupee and its volatility was less compared to its EME peers. And this reflects India's strong macroeconomic fundamentals and improvement in the external sector outlook. The Reserve Bank's exchange rate policy has remained consistent over the years, and it is market determined. Its central tenet is to maintain orderliness and stability without compromising market efficiency. Foreign exchange reserves are deployed judiciously to mitigate undue volatility, maintain market confidence, anchor expectations, and preserve overall financial stability. These interventions focus on smoothing excessive and disruptive volatility rather than targeting any specific exchange rate level or band. At the same time, our effort to deepen and modernize the foreign exchange market have also yielded significant results in terms of, first, widening access and participation, and second, ensuring efficiency and ensuring efficient price discovery. Our overall approach ensures that forex reserves act as shock absorbers, safeguarding the economy from external spillovers, while supporting competitive and orderly market conditions. The flexible or market-determined exchange rate regime is not merely a tool for managing external shocks. It is an important element of our approach to macroeconomic and financial stability. By combining market discipline with prudent intervention, we have created a system that supports stability, resilience, and growth. Let me now focus on financial stability. The financial parameters of banks and NBFCs continue to be strong. The incoming data suggest that the gap between growth of credit and deposits of scheduled commercial banks has narrowed, with deposits keeping pace with loan growth. In fact, on the financial sector, I can say with confidence that I think the health of the financial sector today is perhaps at one of its best in a long time. The Reserve Bank supervision of the financial sector and its entities continues to be vigilant and proactive. Incipient signs of stress, if any, either at the systemic or entity levels, are monitored closely and proactive action is initiated. The effort is always to resolve the issues non-disruptively. Continuous engagement is held over several months, sometimes even exceeding 1 year, with the regulated entities. Only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. In fact, there are a large number of entities where the corrective action is taken and where we simply do not take any action because the response by the regulated entities is found to be, very proactive and, very responsive. And so in many cases, without imposing any restrictions on their business or other kinds of activities, the problem gets resolved. Obviously, the list is not known outside. That list is much longer. And the total number of entities, I'm not being defensive about it or in any way. Why I'm emphasizing on this is that this is something which we have to do in the interest of stability of the system as well as the stability and health of the individual entities. So only in extreme cases where sufficient corrective action is not visible, the Reserve Bank resorts to imposition of business restrictions as a last resort in the interest of consumers and financial stability. To address the issues of unclaimed deposits, inoperative accounts, and frozen accounts due to pendency of KYC updation, banks have been advised very recently, once again, to take necessary steps urgently to bring down the number of such accounts and make the process hassle-free. Further, banks have been advised to segregate the accounts of beneficiaries of various central and state government schemes through direct benefit transfer, that is DBT, and facilitate uninterrupted credit of the DBT amounts into their accounts, and also utilization of the DBT amounts by the account holders. And we have advised the banks to do it without inconveniencing such vulnerable segments of customers, because the DBT beneficiaries are usually, and they are the vulnerable sections of the society. So being fully mindful of that, we have emphasized that there should be a kind of a seamless and smooth flow of DBT amounts into the bank accounts of such individuals in a situation so that it facilitates, the individuals to withdraw the money to meet their various requirements. Progress made by individual banks in this regard will be monitored by the Reserve Bank. I would now like to turn to the external sector. The statement today is a bit, because we have too many announcements, so I request your continued patience. External sector. India's merchandise exports expanded at a 28-month high pace in October. Merchandise imports also increased for the 7th consecutive month. Services exports sustained buoyancy and posted double-digit growth in second quarter as well as in October 2024. The robust services exports, together with strong remittance receipts, are expected to keep the current account deficit within sustainable levels during 24-25. On the external financing side, gross FDI to India increased at a robust pace. I'm talking about gross. The gross FDI to India increased at a robust pace during the first half of the year. Net FDI, however, moderated during this period due to higher repatriations and rising outward FDI. Foreign portfolio investment, that is FPI inflows to EMEs have generally declined in October. Net FPI inflows to India stands at US $9.3 billion so far in the current year, that is from April to December 4th. And this was supported mainly by inflows in the debt segment. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the last year. India's external sector remains resilient, as reflected in various key indicators where India has been consistently performing well. And the key indicators and the data they are given in the footnotes. In order to attract more capital inflows, it has been decided to increase the interest rate ceilings on FCNRB deposits. Accordingly, effective from today, banks are permitted to raise FCNRB deposits of 1 year to less than 3 years maturity at rates not exceeding the ceiling of overnight alternate reference rate, that is overnight ARR, plus 400 basis points as against 200 basis points at present. So in addition to the overnight ARR, currently the banks are allowed a spread of 250 basis points that is being increased to 400 basis points. Similarly, for deposits of 3 to 5 years maturity, the ceiling has been increased to overnight ARR plus 500 basis points as against 300 basis points at present. This relaxation will be available till 31st March 2025. I shall now announce certain additional measures. I again request your patience because the additional measures, they are very important. The first one relates to the FX retail platform, and this is how it is. The FX retail platform, which was launched in 2019, is now proposed to be linked with the Bharat Connect platform of the NPCI. This would enable users to transact on the FX retail platform through mobile apps of banks and non-bank payment system providers. This will expand the reach of FX retail platform, enhance user experience, and promote fairness and transparency in pricing with adequate safeguards. The second announcement relates to introduction of secured overnight rupee rate, SORR, a benchmark based on secured money markets. With a view to further develop the interest rate derivative market in India and improve the credibility of interest rate benchmarks, the Reserve Bank proposes to introduce a new benchmark, namely secured overnight rupee rate, that is SORR, which is based on all secured money market transactions, that is overnight market repo as well as TREPs. The third announcement relates to Connect to Regulate, an initiative for open regulation. As part of Reserve Bank's consultative approach in framing regulations, a new program, namely Connect to Regulate, will be launched under the ongoing RBI at 90 commemorative events. A dedicated section in the Reserve Bank's website will be made available for stakeholders to share their ideas and inputs on specific topics. So we will give out a specific topic on that. We are not going to upload a discussion paper or anything, but we will just mention the topic, and we would like all stakeholders to give their opinion, suggestion and thoughts to the RBI. So it is that makes our process of consultation much wider and much more flexible, which has been our approach over the last few years. Next announcement is introduction of podcast facility as an additional medium of communication. Over the years, the Reserve Bank has expanded its communication toolkit and techniques to enhance transparency and better connect with the people. In continuance of this endeavor, the Reserve Bank proposes to add podcasts to its communication toolkit for wider dissemination of information. And the next announcement, which I am going to read out, is very important for the agricultural sector, especially for small farmers. And that relates to collateral-free agricultural loan enhancement of limit. The limit for collateral agricultural loans was last revised in 2019. Taking into account the rise in agricultural input costs and overall inflation, it has been decided to increase the limit for collateral-free agriculture loans from rupees 1.6 lakh crore per borrower to rupees 2 lakh per borrower. This will further enhance credit availability for small and marginal farmers. The next announcement relates to UPI. A credit line on UPI was launched in September 2023 and was made available through scheduled commercial banks. It has now been decided to permit small finance banks also to extend pre-sanctioned credit lines through the UPI. This will further deepen financial inclusion and enhance formal credit, particularly for the new-to-credit customers. Next announcement relates to artificial intelligence, its deployment in a very prudent manner. The financial sector landscape is witnessing rapid transformation enabled by technologies such as AI, tokenization, cloud computing, etc. In order to harness the benefits from these technologies while addressing the associated risks such as algorithmic bias, explainability, data privacy, etc., a committee comprising of experts from diverse fields will be set up to recommend a framework for responsible and ethical enablement of AI. I repeat, a framework for responsible and ethical enablement of AI, and the acronym is FREE AI in the financial sector. The last announcement relates to dealing with mule accounts. As part of the Reserve Bank's continued efforts to prevent and mitigate digital frauds, an innovative AI/ML-based model, namely the MuleHunter.ai, has been developed by the Reserve Bank Innovation Hub at Bengaluru. This will help the banks to deal with the issue of mule accounts expeditiously and reduce digital frauds. Let me now conclude. The world today is characterized by intricate complexities and profound uncertainties. As a central bank, our job is that of an anchor of stability and confidence, which would ensure that the economy achieves sustained high growth. Since the last policy, that is since the October policy, inflation has been on the upside while there has been a moderation in growth. Accordingly, the MPC has adopted a prudent and cautious approach in this meeting to wait for better visibility on the growth and inflation outlook. At such a critical juncture, prudence, practicality, and timing, I repeat, at such a critical juncture, prudence, practicality, and timing of decisions become even more critical. Our endeavor in the Reserve Bank has always been to implement timely and carefully calibrated measures to derive the maximum impact. This will continue to be the guiding principle for all future actions also. As Mahatma Gandhi had said, and I quote, "There is nothing that cannot be attained by patience and equanimity." In the last few years, we have traversed one of the most difficult periods in the history of the Indian economy and perhaps in the global economy. And this has been a very difficult period in the economic history, in the history of Indian economy and the global economy, just as I pointed out. It was a period of relentless turbulence and jolts. As a country, we can derive satisfaction that the Indian economy has not just navigated this period of trials successfully, but has emerged stronger. As we strive together towards making India a developed economy, I recall what I had said in my statement of February 8, 2023, wherein I had quoted Netaji Subhash Chandra Bose, "Never lose your faith in the destiny of India." Thank you. Namaskar.
Okay, so as expected, no repo cut, but a CRR cut of 50 basis. No stinginess, not 25 spaced out, but a clear 1.16 lakh crore coming into the banking system. I'm not surprised that the Bank Nifty is the one that is most triumphant. We've not seen much of a move in the bond yields because, after all, there is no repo change. In fact, the bond yield went up about 3 or 4 basis points and then came down. But the important point was the last few words he said, that we believe in prudent, timely spacing of steps. Is there any hidden word over there in terms of when the repo cut comes in? And if you looked at the way in which they have given us future inflation forecasts, while they have raised the inflation forecast for the current year and even for Q1 of next year, the new number we have is Q2 of next year, which is what? 4%. So is that an indication that in February, given that you can see 4%, the RBI can argue that we are aligning towards the target? Should we take a clue from there is what the market will be asking itself. On GDP, I think the acknowledgement that we are at 6.8 in the current quarter, they're not even working with 7, is perhaps welcome, and therefore the 7.2 of Q4, which is the new forecast, will hold more credibility. At 6.6% for the full year, the Reserve Bank still remains one of the highest on the street in terms of growth forecast. The highest we got otherwise was 6.5. But markets and most of us perhaps outguessed the Reserve Bank correctly on both the interest rate front and on the CRR front. We have a very diverse panel of experts with us. We have economists, we have bond dealers, and we have a banker. And today it's the banker who's most important. Rajiv Anand, the Deputy Managing Director at Axis Bank. Rajiv, what does the CRR cut mean? Does it mean deposit rates have peaked for now?
Clearly, I think the fact that we're going to get over 1 lakh crores of liquidity into the system clearly indicates that one of the things that I've been mentioning is that overnight rates are at 6.5%. On the margin, 1 year deposit rates are anything between 7.5% to 8%. in an environment where the next move is certainly down, that gap is just too much. And I think with this CRR cut, we are going to see deposit rates come off over the next 3 months or so. So a very simple answer to the question that you're asking: have deposit rates peaked? Absolutely.
For most banks, the NIMs would rise by about 3 to 5 basis points.
I think that's a fair estimate. Remember, the impact is not going to come through in this quarter, but it will come through, from the next quarter onwards. But I think an estimate of 3 to 5 basis points is about right.
And when may lending rates go down, you think?
There is no reason for lending rates to go down at this point in time. Anyway, we've seen a significant reduction in
deposit rates have peaked.
But remember that on the corporate side, pricing is quite tight anyway, and we've seen a slowdown on the credit side over the last 3 to 4 months, and so therefore I don't expect any material move as far as lending rates are concerned. And remember that much of the book is now EBLR linked, and so therefore you should expect a material change only when the repo rate changes, which, given the expectations on inflation, look like it's been pushed out by some time.
Oh, by some time. See, that's the question now to the economists. Upasana, he said something in the end about how our policies are prudent, timely, practical. So are you reading a rate cut in February, especially because the second quarter forecast for CPI is 4%?
Yes, Lata, as you correctly mentioned, I think there are 2-3 aspects to this. One, while RBI has revised down their estimates, they still remain on an average in the second half of the year at 7%. We see a fair amount of downside to that. Yes. And as we see incremental, more high-frequency data coming in, the RBI too will come to realize that there is downside to their own estimates. That's one. Two, of course, the second quarter inflation reading at 4% is suggestive that from henceforth, 6 months down the line, that is what RBI should be focusing on, how they are looking at inflation trajectory, and that disinflation towards the last mile is being achieved by 6 to 9 months down the line. And I think that's when we do see a window open for the February rate cut. Much will, of course, depend on how the global environment will, of course, pan out. And that is going to be playing a very important role in determining the timing. Yeah. But I think definitely the February rate cut is on the table.
Yeah, it's on the table. Of course, Jan 20th, Trump takes office. So, as you say, the governor will have one eye on the external matters, inflows, outflows, value of the dollar. But for the moment, actually, there's a bit of celebration in the rupee market as well. The rupee has moved stronger from where it began. We are now south of 84.6, moving towards 84.58, 84.57. That's quite a bit of a gain that the rupee has seen. Kaushik, first takeaways from what the governor has said, especially in terms of when you expect a cut.
So Lata, we are very happy. This is extremely prudent and practical decision because we were in favor of a CRR cut first to improve the liquidity and then do a repo rate cut at some point, which we think will be February. Because I think January-March inflation will also fall to 4% because October-December we are going to get something like 5.5, 5.6 average. Therefore, the disinflation of vegetable prices will be very strong in January, February. So not just April, June, I think the first half of 2025, you could have a situation where inflation is at 4%. And RBI is always forward-looking. So when they come to February, after having, kind of done the CRR cut and before the sequencing of changing the stance to neutral, I think February will be a good time to start the rate cut. Not because data is very poor at that point of time, but you're looking ahead in the next 2-3 quarters and taking a call. If you don't cut at that point of time, whether you'll be behind the curve. And I think February will be a good time after the budget because we think the fiscal consolidation will continue. And therefore, you need some monetary policy support. RBI is saying 6.6, and you're pointing out that there is some downside risk to that as well. And we know that 6.5, 6.6 for India's growth is below potential. So in order to keep it at 6.5, 7 with this global, backdrop of, Trump administration, you need some monetary policy support. And I think 50 basis points rate cut over February and April will make a lot of sense. We also believe that at some point, RBI will push the short-term rates to the SDF and have an effective easing of 75 basis points in this cycle, which will help growth to remain in the 6.5, 7% zone for the next few years, despite the global backdrop. So to answer your question, I think February is the best time to do the rate cut.
Okay, actually, yeah. Got it. I just want Rajiv once again. Rajiv, I think another very important announcement has been raising the ceiling on inviting NRI deposits. The ceiling was for 1 to 3 year FCNRB rate could not go above the overnight ARR rate plus 200. Now you can go up to overnight ARR rate plus 400. And likewise, from the 3 to 5 years as well, another 2 percentage points increase in the rates can be given by banks. You expect decent flows, and do you think that's why the rupee also is appreciated?
I think it's been well articulated that the RBI is running a short dollar position in the forward market, and I think it is very keen to attract dollar deposits. But I think the problem currently is that anyway FCNRB rates are well below even the old ceiling, and so therefore to that extent increasing the ceiling at this point in time I don't think will make too much of a difference. What would perhaps have worked is if for the incremental FCNRB some sort of CRR dispensation was given, that would have incentivized the banks to go down this road. But I think this increase in ceiling may not have too much of an impact.
Okay, Kanika, thank you for standing by. Quickly, your key takeaways, and the governor making two very clear statements. One, that growth in the second quarter has bottomed out. He sees an upside with that 6.6% forecast in mind. And on CPI again, after the third quarter, fourth quarter onwards, easing is expected all the way down to 4% by the second quarter. Keeping that in mind, is February your base case as well for a rate cut?
So Ritu, thanks for having me on the show. Yes, February is a base case for us as well. And we are calling for 25 basis points rate cut in Feb and April. We'll ascertain more depending upon how the growth trajectory pans out. See, it's very important to understand just two key takeaways from our side. First, even though growth is recovering in the second half, because 5.4% in Q2 itself had a base effect to it. But from an inflation standpoint, after the 5.8% spike or a higher than expected inflation number from MPC's perspective, the 4.5% growth, 4.5% inflation for the last quarter, in our view, it actually has an element of a downward surprise unless weather shocks materialize significantly. In fact, 42% vegetables inflation in October, if it squares off by March, you can see a downward surprise on inflation, which is exactly why we are calling for that rate cut in Feb. There's only one risk we want to point out too. While the governor just mentioned about global uncertainties, heightened geopolitical risks as well. But we think unless and until dollar volatility stabilizes, the shift in policy may become challenging across central banks in emerging markets, including India. So Fed is a base case, but the risk we want to watch out for is stabilization of dollar, especially after Trump takes office on 28th Jan. Thanks.
No, absolutely. The external environment is one of the key risks to watch out for, especially in January after, like you said, Donald Trump takes over as president. Shobhit, thank you again for standing by. Your quick takeaways, not much of a move again on bonds. Of course, the rupee, we've seen some improvement.
Yeah, hi. I think the key takeaway is the basically adverse growth inflation dynamic forcing RBI to wait and watch. Confirm whether the decline in inflation actually happens and growth actually picks up. So I think these two are the key parameters which RBI would focus on if indeed growth picks up and inflation comes off, and global developments post Jan 20th are not as disturbing for markets. then perhaps Feb would be live for starting the easing cycle. But in our view, in my view, especially, easing cycle this time around is only 50 basis points. So perhaps if we start in Feb, the next one may not happen in April, but could be pushed out. So, if we are going to see only 2 rate cuts, then the longer they are spread out, the more the benefit could happen in the markets.
All right. Rajiv, that CRR cut last we spoke, you were hoping for, that has been delivered. You said not much move on the lending front yet. Deposit rates have peaked. But what do you make of some of the other measures that have been announced, specifically on the collateral-free agriculture loan limit being raised? What sort of additional credit do you think that would unlock? What do you make of, how significant the move could be?
I think they're all positive moves. It's difficult to estimate. Also, obviously, there will be more, credit that is available to the agricultural sector. But I think what is more important from our perspective as well, our ability to now to meet our PSL requirements, particularly in the small and marginal farmer category, improves, thanks to this. And so therefore, to that extent, this is positive for banks as well.
A lot of commentary, Rajiv, again, from the Reserve Bank of India on these mule accounts. And we've been repeatedly hearing this for the last many, many months. Is there specific directives from the RBI? Are you expecting some regulatory guidelines on this? Could there be some punitive measures in areas where RBI is seeing some issues with regards to too many mule accounts not being handled?
I think the issue, Ritu, is systemic. This is a problem, that all banks are seeing of, fraudsters becoming more and more innovative, being able to open accounts either physically or digitally, sit in the banking system, and then use these accounts to be able to do teaming and lading, etc. So this is a challenge that all banks are currently grappling with. We are working with the RBI and enforcement agencies to see how we can tighten our KYC norms on one side, and to be able to use technology to identify some of these mule accounts and either debit freeze them or actually shut them down as well.
Okay. Well, I guess those efforts would be on anyways between RBI and the banks. But clearly they have upped the ante on this, and this could have a lot of ramifications even for the kind of activities we see in the stock market. I want to come back to the growth story. We have to remember that the Reserve Bank said that the second quarter, the fall in growth has bottomed out, but they have sizably cut the second half forecast from 7.4 originally to 6.8. Now that's a 60 basis point cut in their current quarter forecast. So they have not, the positivity in the third quarter also is not that gung-ho. And then they go on to 7.2, which some may consider ambitious. Upasana, ambitious, you think?
Lata, I'll take it like a H2 versus a H1. And yes, as you mentioned, the quarterly profiling. But if I go by what RBI's estimates are, at 6.6%, the second half of the year is at 7%. Compared to a 6%, compared to a 6% in the backdrop of a 8.2% average last year.
Correct.
So I think that is something which, if you look at, I see a significant downside. Yes, they have revised down significantly their third quarter estimates, but I believe there's further downside to these numbers. I think overall the headline GDP for the full year would be somewhere, we are at 6.1%. With a little bit of, anywhere in between 6 to 6.3% is our range. So I think there is significant amount of downside further to RBI's estimates currently.
Yeah. I mean, we should not have celebrated the 8.2 of last year, because that was a large bit of net taxes which were adding to the GDP. We should have concentrated on the GVA. And even then, the GVA for the last 2 quarters in the previous year were fairly strong. So we are struggling with a big base, even for the current Q4, and therefore 7.2 could be a slightly ambitious number, especially given the headwinds on the external account, more in terms of uncertainty. Though economies are resilient, there is uncertainty as far as the fourth quarter is concerned when the new government is sworn in in the United States. Kanika, now very rapidly, I want both the economists also to comment on the growth number. What would your number be? You think 6.8, 7.2 is ambitious?
So Lata, for second half, we are at around 6.7, 6.8. 7% plus growth number looks difficult, which they have penciled in for the last quarter, given weak credit impulse. And as you talked about, global uncertainty means broad-based private capex recovery is missing. Yes, agri will surprise you on the upside. You can get a 4 to 5% handle there, and government spending pickup will support. But it may not be adequate enough to give a 7% plus growth number, which is why growth is a concern, needs policy stimulus. In fact, we think it should be a combination of fiscal and monetary stimulus.
I just want a brief answer. Okay, Kanika, got it. We have to be brief now. We have to wind up. Kaushik, what's your second half?
Yeah, we have something like 6.8, 6.9. We haven't changed, and our full year forecast is 6.5. Remember that in February, when the data comes out for October, December, it'll come out with a lot of revisions of the past data. So it's very possible that FY24, the 8.2% number that you got will be revised down, towards 8%, and suddenly second half might look much better, even if it is statistical.
Yeah. Okay. Yeah, I mean, those are, of course, imponderables which the Reserve Bank can't work into its model. But even after having brought down its forecast to 6.6, all the three economists over here believe it is perhaps still an ambitious number. That tells you something about the pace of the economy. Finally, Shobit, I wanted to ask you, now that this liquidity is coming in, will CP/CD rates start falling?
Yes, I think because of tight liquidity, there was some upward pressure on the extreme short-end yields. There would be easing. We saw a lot of issuance by banks of CDs recently. And I think there would be definitely some easing on the short end. 3 months to 6 months money market yields would definitely improve from here on.
Okay. Well, gentlemen, thank you very much. Actually, ladies and gentlemen, thank you very much indeed for joining us on this special monetary policy show. The policy has lived up to its importance and the cruciality that it was invested in.